There are just some things in life where you can't have one without the other. You can't have bacon without some eggs. Chandler just wouldn't be the same without Joey. And my favorite, where would Captain Kirk be without Spock? In the same way, in the world of investing, these two index funds are just inseparable. Vanguard's Total Stock Market Index Fund, VTSAX, and Vanguard's Total Bond Market Index Fund, VBTLX. Independently, they may be good funds, but together they make one of the most powerful wealth building tools in your arsenal. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Today we're going to deep dive into my personal favorite and ultimate investment duel, the VTSAX and the VBTLX, and why with just these two simple funds, you can be well on your way to growing your net worth. The video is broken down into three major categories, so feel free to jump around to the section you find most useful. First, we'll deep dive into Vanguard's Total Stock Market Index Fund, VTSAX, what it is and why you want it as your core wealth building tool. Second, we'll deep dive into Vanguard's Total Bond Market Index Fund, VBTLX, and similarly, what it is and why you want it in your portfolio. And third, we'll see the true power of its combination on your slow and steady path to wealth. Alright, let's talk about Vanguard's Total Stock Market Index Fund. If VTSAX was a character in Star Trek, it would definitely be Captain Kirk. Adventurous, bold, and willing to take calculated risks for greater returns. An ETF equivalent is Vanguard's Total Stock Market ETF, VTI, and it has an expense ratio of 0.04% with a minimum investment of $3,000. Vanguard's Total Stock Market Index Fund in essence represents all publicly traded companies in the United States. At the time of this video, there are approximately 4,000 public companies in the US, and this one fund represents pretty much all of them. Big boy companies like Apple, Amazon, and Microsoft, as well as thousands of lesser known ones. When you purchase VTSAX, you're essentially buying a piece of every one of these companies. And buying stocks is one of the best ways to tap into the growth of the greater American economy and thus grow your net worth. However, buying individual stocks is risky because, to be honest, unless you're a professional investor like Warren Buffett or Peter Lynch, we never know what stocks will do well or not do well. Thus, the importance of this concept called diversification when it comes to investing. Not putting all your eggs in one basket, but spreading it around so you're well diversified. And when you invest in a fund like Vanguard's Total Stock Market Index Fund, you automatically get this diversification across thousands of publicly traded companies. On top of that, another great aspect of investing in VTSAX is the fact that the fund is self-cleansing. What does this mean? It means that the fund automatically recycles bankrupt companies while at the same time retaining those that are continuously creating value for its customers. No person, aka fund manager, is doing this. This is just a natural byproduct of holding all publicly traded companies based on market capitalization. And stocks have unlimited potential to go up. Just look at a company like Apple. In the last 40 years since 1982, the stock increased in value by 230,000%. However, how many of us can honestly say that if we were looking at Apple 40 years ago, we would know that it would become the company that it is today? Not many of us. But when you hold on to Vanguard's Total Stock Market Index Fund, you naturally get the upside of growing companies like Apple. And on the downside, you're protected because the lowest a company can go is zero. It can't fall any further. When a company fails, it will go bankrupt and disappear, essentially making the stock price zero. But there are always hundreds of new companies coming to take the reign. Young companies that could one day also be the new Apple. And though at the time of this video, the market looks a bit shaky, when you step back and look at the bigger picture, 10, 20, 30 years, the market, thus the index, normally goes up. In the last 10 years, VTSAX had an average return of almost 15% annually. That means that if you had invested $1,000 10 years ago, it would have grown to $4,000 from just the compounding growth alone. 4 times your original investment, and you did nothing except invest in VTSAX. If you want to really grow your net worth, invest in Vanguard's Total Stock Market Index Fund and hold it for life. However, you can't go through life alone. And that is the same with our investment friends. Captain Kirk always has Spock at his side, providing him the calm, rational voice in times of many crises. In the same way, if Vanguard's Total Stock Market Index Fund is our Captain Kirk, Vanguard Total Bond Market Index Fund, VBTLX, is our Spock. Calm, steady, and to be honest, a little boring. At a high level, a good way to think about bonds in comparison to stocks is to consider them as investments that will smooth out our volatile stock investment ride. Stocks are great wealth building tools for the long run. However, in the short term, they can be quite volatile, moving up and down constantly at a whim of slightest threatening news. Bonds, on the other hand, might not have the big long-term returns, but it doesn't have all that volatility that comes with stocks. And in my opinion, Vanguard Total Bond Market Index Fund, VBTLX, is the one and only bond fund you need in your portfolio to help smooth out your investment ride. An ETF equivalent is Vanguard Total Bond Market ETF, BND. It has an expense ratio of 0.05% with a minimum investment of $3,000. VBTLX is made up of over 10,000 individual bonds within its fund with varying credit ratings, issuers, and maturity dates. And this wide diversification of VBTLX makes it one of the best choices when it comes to investing in bonds because it minimizes all the risk that comes with holding individual bonds. Let's talk about these risks. The first risk that I'd like to discuss is default risk that comes with holding bonds. Bonds are essentially loans to governments or corporations, and responsible organizations like responsible individuals ensure they meet their debt obligation, paying back you, the lender, regularly and on time. However, what happens if the organization is struggling to make its payments and defaults? You as the bondholder won't get your money back. So in order to help investors evaluate the risks of any company or government bonds that they're thinking about purchasing, various rating agencies like the Standard & Poor's evaluate their creditworthiness and give a grade, ranging from AAA to D. Just like school grades, lower the rating, the higher the risk of default. Higher risk bonds, like BB and lower, offer a higher interest rate because people are less willing to buy these high risk investments. So as a buyer of bonds, if you're willing to accept this higher risk, higher the interest rate you receive. Vanguard's Total Bond Index Fund, VBTLX, mitigates against this default risk by holding only investment-grade bonds. There's no bonds within VBTLX rated lower than BBB. Vanguard wants to provide you good returns, but not at the expense of unnecessary risks. Another risk that comes with owning bonds is the interest rate risk. This only comes into play if you decide to sell your bonds before the maturity date at the end of the term, but it's a factor you want to consider. Let's say that you're looking to sell your bond before the maturity date. If the going interest rate has changed since your purchase, the value of the bond will change as well. For example, if the interest rate has gone up since your purchase, the value of your bond will have decreased. Because when the market interest rate is higher, new bonds may be issued with higher interest rate, thus making the original bond with a lower interest rate less attractive. If you as a bondholder want to sell it, you'll need to offer it at a discount in order to make it attractive in comparison to new bonds that are being issued with higher interest rate. If you're holding on to a few specific bonds with these lower interest rates, you could be at a world's hurt whenever the interest rate changes. But again, when you hold on to VBTLX, because it's holding bonds of widely differing maturity dates, your interest rate risk is mitigated. The third risk is inflation risk that comes with bonds. Inflation occurs when the cost of good is rising. If you watch any news lately, it seems like everyone is talking about inflation given how high it is right now. Bond interest rate is set by the anticipated inflation rate. Generally, short-term bonds pay less interest because it's associated with less risk. It's a shorter time horizon, and your money is tied up for a shorter period of time. And long-term bonds pay more in interest because of higher associated risk. I know it can be a bit confusing, but the bottom line is that if you decide to purchase individual bonds, you need to effectively manage this inflation risk, anticipating what the inflation will do in the future and making your corresponding bond purchases. Again, this is where VBTLX shines because when you purchase VBTLX, the fund already holds various bonds across a broad range of terms, short-term, mid-term, and long-term, effectively reducing inflation risk. No need to try to predict the future with a magic ball because honestly, none of us can. The bottom line is that when it comes to bonds, Vanguard's Total Bond Index Fund, the VBTLX, is really the only fund you need to hold in order to gain all the benefits that comes with holding bonds while mitigating all the risks like default, interest, and inflation risks. And when you combine Vanguard's Total Bond Index Fund and Vanguard Total Stock Market Index Fund, you really get the ultimate investment duo that is second to none. VTSAX acts as our core wealth building tool, providing us strong returns over a long period of time. VBTLX acts as our less volatile partner that smooths out all the volatile ups and downs in our wealth building ride. Let's take a look at how this looks in action. If you're to compare the total stock market trends, VTSAX, versus the total bond market index, VBTLX, the past 20 years, VBTLX has smaller overall gains, but has much less volatility than VTSAX. What having bonds in your portfolio will do for you is that during the times of market crash when your stock market investment can dip by 20 to 30%, your bond investment will hold your portfolio steady. Now, if you're in your 20s and 30s and don't plan on dipping into your investments anytime soon, having the majority of your investment in stocks is a better move. You have time on your side to ride out the ups and downs of the stock market. However, if you're nearing retirement and you want to tap into your nest egg soon, you want bonds in your portfolio. You don't want to be caught in a situation where you need to pull your money from the stock market when it's 20 to 30% down. Another power of having these two funds in your portfolio is that you're essentially protecting yourself from both inflation and deflation risk. Inflation and deflation are two big macro risks that impact our portfolio, and they can really hurt us if we're not adequately prepared. However, when you have stocks like Vanguard's Total Stock Index Fund, it naturally provides you with inflation hedge because stocks in general rise with the value of inflation. And bonds like Vanguard's Total Bond Index Fund provides you with good deflation hedge. Because when the money in the bond lent out is paid back, you have more purchasing power due to the decrease in price at deflation cost. Deflation occurs when the price of stuff falls. We're currently in an inflation period, but the market has its own ebbs and flows, so we won't know when we'll enter a deflation period. Being invested in VTSAX provides us a good hedge against inflation, but we want to be prepared for periods of deflation as well with VBTLX. Remember, we're long-term investors, not market timers. Thank you guys for watching, and if you want to deep dive even more into each one of these specific funds, check out a few of my videos here. Until next time, all the best.